These are back.
The important thing I think to note is Robinhood makes money effectively, as Chamath pointed out, through arbitrage of pricing in the markets and by providing leverage to their clients. So the clients can trade beyond their means. I used to be an investor in a Forex trading company. It was the largest Forex trading platform in the world for retail investors. And 60% of those accounts went bankrupt over time. So there was a lifetime value on an account because the customer would come in, they'd trade foreign exchange rates up and down. They would ultimately just get burnt up, and that was it. Robinhood makes money when the market is non-volatile, when there isn't a lot of swings. Suddenly, when there is a swing, and that's how they're able to provide their free pricing to people, they're making a spread. But suddenly, when there is a swing and the spreads start to widen, they are actually exposed to losing money. So, Jason, it's true what Chamath is saying. Like, they did face a liquidity crisis to some extent. That's why they had to draw down additional equity capital.
Yeah.
But it was a function of their business model, right? Their business model provides great benefit and value in some extent during good times, but when times get bad, it's like, oh shit, things are at risk. And that's very similar to kind of the Lehman and
I don't disagree.
model.
I don't disagree. I think this is an unprecedented situation with the number of participants. It reminds me of surge pricing with Uber during snowstorms. And that also was an unintended thing that, who knew that it would go up to $400 to take a ride? And that's something that companies will be faced with, and they will have to then adjust and then make it work. And I think, in the case of Robinhood, they should have just came up on Wednesday and said, we can't take any more orders. We can't take any more new customers. We're pausing signups. You'll be on a wait list because we will be insolvent if you guys make any more trades. And that would have, I don't know if you believe that would have.
I agree with that.
Okay.
So Jason, let me just explain the mechanic.
So then it's poor communication from a rookie founder.
Not. Jason, it's beyond poor communication. People were blocked out of their accounts. Like there was hundreds of incalculable amounts of economic loss.
I don't know if that's going to wind up being true because all these trades are occurring now and the stock is a rocket ship. Who's to say that?
No. Jason.
And aren't the shorts all covered by now? That's what they've been saying on CNBC.
No.
There are still people. How do you know how many people are short right now and how many shares?
Because it's the primes put the data together and they send it to us.
Do you have it handy? Because I've been looking for it online and they said 10 times the number of shares short have traded hands in the last 10 days or 5 days.
Jason, I don't have it literally in front of me, but I could get it in the next hour.
Yeah, just text one of your people. You got all these researchers there. Go ahead, Zach.
Okay, look, I'm going to try and thread the needle here. I think JCal is right that we shouldn't impugn people's motives without having all the information. And furthermore, building these rapidly scaling startups is really tough, and it could have just been, a function of not knowing how to deal with unprecedented growing pains. So I don't want to be too judgmental.
Can I just stop you there?
Yeah.
No, but that's not. No, but David, that's not. But you guys are not being accurate. They have known for years, how this business works. When somebody buys a call option, they are legally obligated. When they send that order through, they have to post margin on behalf of that person. So they saw this building. This happened in March of 2020. They went through this liquidity crisis. They've had to draw credit lines before. They saw it building in the system. So this was nothing except negligence.
Yeah. So I was about to, I hadn't gotten to the part where I was about to agree with you, Chamath. I mean, look, all I'm saying is even if it was negligence, I'm not sure I would impugn all the motives to them. That's all I'm saying. I'm trying to find some common ground with JCal on that point. But where I totally agree with you, Chamath, is with respect to the effects of their decision. I mean, the effects of that decision they made to stop trading, and specifically, they didn't stop people from selling. They only stopped people from buying. So they shut down one side of the trade. And the effect of that was we had these hedge funds from Wall Street. They were on the ropes, right? I mean, let's discuss who these guys are. These are the apex predators of Wall Street. They are in the business of shorting companies to destroy them. I mean, that is their business model. And they are not academic traders, okay, who are just speculating on outcome. They engineer the outcome, right? Look at their tactics. Just watch the show Billions, right? They hire PR people. They hire private investigators. They're participating on these message boards, spreading disinformation. Look at the year of hell that Elon went through, right? They tried to destroy
it's like 5
Tesla.
years. Yeah.
Yeah, exactly. They try to destroy companies to engineer that outcome. They create nothing. They are in the business of destruction. Now, The beautiful thing is you had these Reddit kids, these pirates who published this manifesto, right, on Reddit, basically being the heirs to Occupy Wall Street. They recognize, look, occupying like a physical space does nothing to these guys. We are going to hurt them where it counts in their pocketbook. We are going to get together and we're going to basically create a trade mob that's even bigger than their cartel. And they did. They got 2.7 million people taking the other side of this trade. And then when the hedge funds doubled down, they said, fuck you. We're going to triple down. And the guy on Reddit said, listen, he, paraphrasing John Maynard Keynes, said, we can be retarded longer than you can be solvent. And they were winning. That was what they said, right? And they were winning the trade, okay? And Melvin was dead busted and Citron was on its way to being dead busted. And they had to go to Big Papa Stevie Cohn, okay? And Ken Griffin to get their rebuys, to buy their rebuys to get back into the game, okay? And then they had these guys on the ropes. They had them felted, okay? And then what happens? Just at the moment where they're going to like basically bust them out of the game for good, Robinhood shuts down the buy side of the trade. And so what does that do? It gives these hedge funds time to regroup, to unspool the trade, to reposition, and save themselves, and to get out of the trade if they want to get out of the trade. You can never take that 24-hour time period back, no matter what Robinhood does now. And so I agree with Chamath. This was
don't you think, David, on that point, I think I am in agreement that the hedge funds deserve to get their asses kicked 100%. I also, as I said, we don't have complete information of why, Robinhood had to pause trading and the other platforms. And it was like 5 platforms, by the way, that had to stop or else they would be insolvent, because nothing like this has ever happened before. This is a run that nobody's ever seen. And now we're back in the game. And don't you think all this attention then drives more people to buy GameStop, which is what's happening today? And that they're still going to get crushed because they're still going to have to cover. I mean,
I don't like I said, look, where I agree with you is I think the consequences of this decision by Robinhood they were really bad, right? I mean, we finally had these shorts on the ropes where they deserve to be. Finally, they're getting a taste of their own medicine.
Yes.
And it was really bad to pull the plug on the
and they wish they didn't have to, I'm sure.
Okay, exactly. And I don't know what went into that decision, but here's the thing that I think kind of stinks about it is the point that Chamath is making about who is doing the trade execution for Robinhood. Those trades are flowing to Citadel.
Well, that's part of it.
That's part of it, but 47%. But who is now on the short side of the trade? Citadel went in and bailed out Melvin and Citron. And so they're on both sides of this trade. Now, how does that make sense?
Well, Citadel, but I mean,
what I would like to know specifically, okay, is did anybody from Citadel reach out and touch Robinhood? Did anybody at Citadel put in the fix and saying to Robinhood,
of course, that's a valid question. Valid question.
We're gonna cut you off, unless you freeze out the buy side. Now, look, 99% chance that didn't happen. I don't know, but that is a legitimate question. We need to know.
Actually, can I just tell you the question is important, but the way that you phrase it is you call them and you basically say, listen, you need to post $500 million of margin. Why? Oh, well, these trades, we're going to arbitrarily change the margin requirements. Okay. Oh, hey, you need to post. So then what they did was they pulled all the credit lines. Okay. They post margin. Trades are still happening like crazy, right? All these people are buying GameStop calls. They have to go because look, when you buy a call, when you as a user, when David Friedberg, Quinoa buys a call, Robinhood becomes synthetically shorted, right? Robinhood doesn't have the share to sell you, but it's giving it to you. So they're technically short. They got to go buy it. Okay. So this is what creates this dynamic where Robinhood they knew every second of every moment what was happening and more importantly, what could happen. At a minimum, it's negligence, and at a maximum, it's the fix.
Well, it was fine to do it before the market started to swing volatile, right? And so when the market wasn't high volume and when it wasn't volatile, it didn't matter because they had appropriate levels of surplus capital or statutory capital or whatever the definition is in this market to be able to cover the quote unquote VAR or the value at risk of their portfolio of their customers' worst case outcome. But as soon as that spiked, as soon as the VAR spiked, they had to go get more capital. And so what do you do if you're the manager of Robinhood in that situation where your clients who've been making you a bunch of money by trading stocks over the last couple of years, suddenly they all get themselves in a bind where the VAR on the portfolio is more than the cash Robinhood has to clear, assuming all these people go bankrupt. That's where Robinhood had to scramble. And so in that circumstance, they drew down debt and they had to go get $1 billion of equity. But if you guys were running that business, and I'm not speaking for Robinhood's, I'm not making the case for Robinhood, but what would you guys have done in that circumstance? Suddenly all your, and by the way, I'm saying they created the problem for themselves because they allowed people to trade on margin with low account balances and volatile stocks prior to this. It got away from them in this week.
You cannot run a business like that and be selective and arbitrary. You can't say some stocks on certain days, some stocks on other days, some options over here, some puts over there. That means you're a fucking moron. And
what
you
do you do on Tuesday or Wednesday when all of a sudden your
exposure... It's not Tuesday or Wednesday. If you were a reasonable manager of a business like this conversation would have been happening at a board meeting quarters ago. Hold on a second. Let me finish, please. Okay. It needs to happen quarters ago. And in quarters ago, what they would have said is, hey guys, we've run some scenario analyses. We've done some sensitivity analyses. Here's what happens if all of these things can go against us. That's a typical stress test that a bank has to do, right? When you're a structurally important bank, you have legislation that forces you to be under these conditions where you have to make sure that you can understand some of these scenarios. And then you have to have...
Same with any trading entity or insurance company, they all have to have that analysis of what's the worst case scenario and how do you plan for it.
And and by the way, coming out of 2008, we actually legislated that we needed to have these 2 and 3 sigma, event scenario planning, and you needed to have proper credit. So here's what happened really. Number one, it was under-equitized. Right. At a minimum, the business was massively under-equitized.
Relative to what they were letting their customers do.
Exactly.
Right? And that's really important because the point is they let people trade with high margin and they let people trade in volatile stocks. And it was working until the volatility.
Not just stocks, but options. Which is what creates the real spin up.
The feedback loop that blows this whole thing up.
And then number two is they don't know what they're doing.